The secret to a great retirement isn't about accumulating more assets. It's actually about selling certain investments at the right time. So in this video, I'll show you the 5 investments that have drained more portfolios than any crash, and a simple approach to make sure a market drop doesn't wipe out your retirement. To start, I need to show you how the hardest investment to sell is often the one that made you rich. But if you don't sell it, it could be the reason you run out of money. Over the last decade, the NASDAQ, the index full of the hottest technology companies, grew by more than 15% per year. If you own these stocks, you made a lot of money. And after a run like that, people don't want to sell. It feels like betrayal, like giving up on the very thing that made you rich. But what happens when you don't? Let's say you retired in 2000 with a $2 million portfolio, all invested in the NASDAQ, and you pull out $100,000 each year to cover expenses. In year 1, the market drops 37%. Your $2 million drops to $1,260,000. Subtract your $100,000 withdrawal, now you're down to $1,160,000. In year 2, down 38%. That brings you to $777,000. After another withdrawal, you're left with $677,000. Year 3 hits again. The market drops another 33%. Your balance falls to $419,000. Pull out another 100, and now it's just $319,000. From $2 million to $319,000 in just 3 years. And even with the strong market recovery, the damage is done. By year 9, the entire portfolio is gone. So how do you invest differently in a way that keeps a bad market from wiping out your life savings? These orange bars show the same time period, but with a diversified portfolio. Instead of 3 huge crashes back to back, the drops are smaller. And just a few years later, your portfolio is nearly back to where it started. So the first investment to sell before retiring is the aggressive stock portfolio that built your wealth, because the wrong timing can destroy decades of smart saving in just a few years. But recognizing that you need to sell the portfolio is only the first step. The real challenge is acting on it in a way that helps you, not hurts you. And this trips up even the smartest retirees, so they think that they can sell at the perfect time, buy back in later, and keep getting great returns. But timing the market is like playing chess. You don't just need one good move, you need several. To successfully move in and out of the market, Vanguard breaks it down into getting 3 big things right, each with its own set of challenges. First, spotting the opportunity. You need a reliable way to spot that something's about to change in the market. This might be the easiest part, but it doesn't matter if you don't get the rest right. Second, take action at the right time. And this involves doing 3 things right. Sell at the perfect moment, not too early or too late. Decide where to invest your money in the meantime, hoping it does better. And you need to know exactly when to get back in before you miss the rebound. And even if you do all that right, the third crucial step is knowing how to manage the details. How many shares do you sell and how many do you buy when you get back in? Can you make enough moving in and out of the market to offset the tax implications or fees? Let's say you do try and time the market and you're able to get all these steps right. How much do you have to gain? Well, in Vanguard's research, they tested what would have happened if you made the right calls over a 26-year period. And they found that even if you were right 75% of the time, your return would have barely been higher than just leaving the portfolio alone. And that's getting it right 75% of the time. Research shows that even the best fund manager will only get their decisions right about 55% of the time. And these managers have teams full of Ivy League graduates with decades of experience. That's why the second thing to get rid of before retiring is the temptation to try and time the market. If the pros can't do it with all their resources, what makes you think you can do it with cable news and a gut feeling? The third investment is the most common portfolio retirees are handed by advisors, and investing this way could quietly cost you over $1 million. After seeing our first example, most retirees know they need to take some risk off the table. But here's the problem. They don't know how much risk to take off. Stocks tend to grow more over time, but with bigger ups and downs. Bonds are more stable, but grow slower. So most advisors play it safe and put you in a 60-40 portfolio. 60% stocks, 40% bonds. But here's what that strategy misses and why it can quietly cost you millions, without adding any real protection to your retirement. Some of the longest bear markets in history have taken around 5 years to recover. So the goal isn't to play safe with everything. It's make sure you have 5 years of expenses set aside in safer investments. Let's say you have a $2 million portfolio. And thanks to a pension, Social Security, or maybe even just low expenses, you only need $40,000 per year. 5 years expenses is $200,000. That's the amount you might set aside in bonds to defend against a long downturn. But a cookie-cutter 60-40 portfolio would mean $800,000 in bonds. That's $600,000 sitting in low-growth investments, defending against a risk you might already be protected from. And keeping that much on the sidelines can mean hundreds of thousands or even millions in missed growth. And that's the difference between we can't afford it and we'll never forget it. So the third investment to sell is any portfolio that isn't built on your actual spending needs. Because when your plan is built around fear, the safe route can quietly become the most expensive mistake of your retirement. The fourth investment is one that even if it averaged 30% returns, you should still get it out of your portfolio. In 1977, legendary investor Peter Lynch took over a tiny fund with Fidelity. Over the next 13 years, it averaged 29% per year, one of the best runs in investing history. But the average investor in the fund actually lost money. When the fund had a big year, like nearly 70% in 1980, people poured in money. But when it dropped, they panicked and pulled it out. They couldn't handle the ride. And that same mistake shows up all the time in retirement. A portfolio that looks better on paper doesn't help you if you abandon it during a downturn. So the fourth investment to sell is the one that doesn't match your risk tolerance. The market doesn't kill your portfolio. Panic does. Because no matter how strong the returns are, if you can't sleep at night, you'll end up selling at the worst time. And the fifth investment to sell is one that makes you feel like you need to time the market. Since the end of 2019, the stock market has more than doubled. And that has quietly changed the risk inside many retirement portfolios. Just look at this chart. It shows a 60-40 portfolio at the end of 2019 and how it shifted over the next 5 years. Without touching a thing, your stock exposure would have climbed from 60% to nearly 75%. And this second chart shows what makes that shift a hidden risk. It shows the range of returns between stocks in a 60-40 portfolio. The worst case drop for an all-stock portfolio is nearly twice as bad as a diversified mix. Without realizing it, you stopped investing for retirement and started gambling it. And when the next downturn hits, you're more likely to panic and sell at the worst time. That's why the fifth investment to sell is a portfolio you never rebalance, because letting your portfolio drift too far can turn market volatility into a retirement-ending mistake. So now you know a great retirement isn't about accumulating more. It's about selling investments at the right time. But even if you get that right, most retirees still make the same costly mistake. They build their portfolio first and figure out their spending plan later, and they end up broke too soon or missing out on the life they saved for. Watch this next. I'll show you the biggest mistake retirees make when building their spending plan and how to fix it before the damage can't be undone.